basics so you can actually take some money that if you've done all your budgeting, you've done all your savings, and now you actually want to invest into the markets, how you can do that the cheapest way possible and also the most effective way possible. So as you know, disclaimer right there, past performance, all that. This is general advice. One thing I did want to say is that, as you guys know, I do have an investment company. I don't do this so that I can, get you guys to come into the office or anything like that. I do it out of the kindness of my heart, and really anybody wants to call me and get help, please do. That's not why I'm doing this. And this is just something that Tracy and I started a long time ago, which is a study into the Word of God when it comes to money. And hopefully you guys have enjoyed it, and really that's why I seek to do it. So that goes along with the disclaimer, I guess. All right, so the first and foremost is that the Lord doesn't want our money, right? Because whose money is it? It's all his, right? He really is looking to get our heart. And that's really what we studied the first week. Along with that, we talked about tithing and how it should be of the first fruits. That's very, very important. It's a test of our heart. It's also the test of the Lord that he seeks at, and that was Malachi 3:8, if I remember correctly. Tithing is biblical, and tithing is a blessing. The principle of blessed versus cursed, we talked about how by tithing we have blessed it, our 90% is blessed, whereas without giving anything, the whole is cursed. Key components of financial stewardship, we talked about budgeting, about saving, paying yourself first, after the Lord, obviously, and budget. Power of compounded interest. I think that woke up a few people. We talked about compounded interest. My wife went home and said, "Hey, how come we didn't do that 20 years ago?" I said, "Because we have 5 kids and we were broke. That's why." But it does work to invest over time. Managing your credit and debt responsibly. And of course, what we're going to talk about today is investment fundamentals. We'll go through the basics. How many people actually did a budget after we did all this, by the way? Hands? No? Nobody? No? Yeah? We talked about owning versus loaning. Managing debt. FICO credit scores, debit credit scores. This is what we talked about, Rule 72. And of course, now it does it this way. Last week it didn't do this. So if somebody asks you, do you want to average 14% return over the last 5 years, 9%, which one are you going to choose? 9%, right? Actually, what your question should be is, how did you get there, right? Because that's the key. Okay, so we're going to talk a little bit about human emotion and investing in the markets. What happens is in today's society is that everything's so quick, right? We're always like, I've talked about this about, so in 1980, when people bought a stock, the average holding period was about 7 years. What do you think it is today? If you bought a stock, the average time you held it was about 7 years. That was the average investor. You remember, it's 7 days today. Yes, you're right. Yes, Sam got that right. Yeah. In other words, the turnover ratio in the markets today is much, much faster than it was, even just 20 years ago. So this cycle of human emotions, what I see, and it's going to be kind of hard because I have to kind of hide you guys, so hang on. There we go. All right. So what we like to do is kind of talk about the markets as an emotional roller coaster, right? So what happens is, like, for instance, Trina, you said to me today, "Hey, Jose, you know what? I was doing some research and I really like to buy some Apple stock." All right, let's go buy some Apple stock. So you buy it, and then a couple days goes by, it starts going up. A week goes by, it doubles, and you're like, I'm a genius. This is easy, right? You get super excited. You get so thrilled that you start telling everybody how much your Apple stock has gone up, right? And that's very common in the stock world. Nobody says, "Hey, I just lost 50% last week," right? They tell their friends and family and everybody around them all about the great stock that they just bought and they're making money. It's called thrill, euphoria. So not only does it happen with individual stocks, though, and here's the thing that I learned over many years is that it happens with the entire market also, right? So what do I mean by that? So on any given day, the market could be euphoric or not euphoric. But you can also look at that market over time. Here it is over time. We saw this chart once before. So if you look at it, this is an emotional roller coaster that you can look at over a decades of period of time, much easier to pick up, right? You can see a clear peak in 1999. Anybody remember the dot-com, right? Clear peak, right? So even though I'm not a genius and I'm not a rocket scientist, as any investor, when you look at that chart, you go, that's a little dangerous, right? And of course, it was down 55% over the next 3 years. Then you look at 2007, 2008 timeframe. That was the credit market debacle, right? Where everybody that could breathe could get a whole mortgage, right? This is how crazy it was. So I have a cousin who called me. This was about 05, 06. And he says, bro, I'm like, who's this? This is your cousin. I have over 91 first cousins, so I don't know who he was. So anyways, he called me. He says, my mom talked to your mom, and she said that you're a financial advisor, so I should talk to you because I'm trying to buy a house. I said, okay, so tell me your situation. He goes, well, I have a good job. I said, okay, great. Where have you been working? He says, well, I work for a maintenance company. I said, well, how much do you make? He said, I make $10 an hour. All right. How much do you have saved up? Well, nothing. So what was my answer? That's right. My answer was, don't buy a house, right? You're not ready. But then he says to me, he says, oh, I was just calling out of courtesy because my mom told you to call you because I already have the house. I already got the loan. I said, what do you mean you already got the loan? He goes, yeah, I've already been approved for $500,000. $10 an hour, job on the job, very little amount of time, $500,000 home. So tell me, as a financial advisor, that didn't perk up my ears real quick. So that, along with some other things, I went to my wife. I said, I know we just bought a house 10 months ago, but we're selling it, right? That was the peak. The actual peak was about a year later, but we were close enough. And that was in credits. That wasn't even in the markets. So what happened was when the markets peaked in the credit market and the debacle happened where I found out that everybody that had a mortgage didn't really deserve to have a mortgage, right? It all fell apart. And that was that right there. You see that gray area, the recession. The gray area is actually the recession. So very emotional time frame, right? During that time frame, what was really crazy is people were making money like crazy in the real estate market. I mean, insane numbers. I had a neighbor that became a real estate agent, and within 6 months, she was making $250,000 a year. No education, no training, no nothing. Because she'd list a house and it'd sell, list a house and it'd sell, list a house and it'd sell, right? So it's not just the stock market that can get emotional, real estate can get emotional. Really, any investor can get emotional. So what we look at, if we go back to our chart, euphoria. Would you say when my cousin got a $500,000 loan, making $10 an hour, no questions asked, no savings, would you say that's euphoria? I'd say so. Or how about this? In 2000, the dot-com era, you basically, if you had a company, you put .com next to it, you were up 300% the next day. It didn't matter if you actually were anything to do with .com. Just put .com on it and you were going to make money. I would say that's euphoria, right? We can go back in history. We talked the tulip craze. We talked about the craze in the 20s over radio and TV, and TV was a little bit later. But there's always a craze. There's always an emotional thing. So one of the things I try to teach in my office, and what I'm trying to teach you guys is, if you all of a sudden see somebody or something going nuts, going crazy, prices going like crazy, run the other way, because that's actually euphoria. You do not want to buy during euphoria. You're basically the bigger sucker, right? That's what it comes down to. If I sell it to you, don't worry about it, it's going to go higher. That guy's going to sell it to that guy, and that's going to go higher. Then you're going to sell it to that guy, and that's going to go higher, right? That's the idea. So what happens is we try to say, well, look, if I buy this house for $250,000, next week it's going to be worth $270,000, so I'll just sell it and I'll make a quick $20,000, I'm out, right? Same thing with stock. If I buy this stock for $100 a share, it's $150 a share 3 days from now, all right, I'm out. But here's what happens. What happens with emotions on that? Just a little more. If I can just get it to go a little higher, right? So what we try to do is that, now let's do the opposite. So now 2005, 2006, 2007, 2008 hit, whammo, real estate crashes, right? Or 2000, stock market crashes. I was at Merrill Lynch at the time, and I would call clients and like, don't talk to me about stocks. Those .com stocks are worthless. Don't call me. I don't want to invest in any stocks. Was that a good time to buy stocks? Absolutely. That's when you want to buy something, when nobody wants it. Because that's when you're going to get the best price, right? And then the cycle continues. The emotion gets back to where people start making money, and then they start talking about it. It just pushes things higher and higher. And that works with everything. Like right now, you can go online, buy a PlayStation for $499 that's selling for $1699. That's $1,699. Why? Because there's none available, right? They sold out first day. So should you buy one for $1,699 or wait just a few weeks and you'll get it for the same price? But euphoria is happening right now in that market. So what happens is the price goes sky high. And I know what happens. The guy that buys it for $699 says, well, if I buy it for $699, I'll sell it next week for $1,800, right? But eventually that collapses. So why am I spending so much time on this? It's because it's very important that you understand when it comes to investing, it's always an emotional decision, whether you want to believe it or not. So what we're trying to do is, how we teach people to do is, let's try to take as much of the emotion out of it as we possibly can. You can't remove it, okay? But let's try to take that. So how do we do that? Well, first of all, let's turn to Ecclesiastes, a well-known book by all of us. Ecclesiastes 11:2. And what am I going to say about Ecclesiastes? So this is funny because when I first saw this, I was like, wow, it really does say this. It really does mean that we can do this. So first rule of investing is diversify, right? You ever heard, don't put all your eggs in one basket, right? We've all heard that, but that just means diversification. So in Ecclesiastes 11:2, it says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth, right? That's pretty close to diversification as I can get, right? In other words, don't put everything in one spot because you just don't know what's going to happen tomorrow. Well, in the markets, the way you diversify, the best way to diversify that we also teach is this. Because people say to me all the time, well, Jose, you're just a stock guy, but I like real estate, right? Well, guess what? I own a home. I like real estate too. But it really should be, it's really, the easiest way to look at it is a third should be real estate, a third should be liquid assets like stocks and bonds, and then a third should be some kind of cash or other investments. That's really how your major portfolio should look. That's the easiest way I can describe it. Now, there's a lot of different things within that, those three sections, because back in 2005, 2006, I would run into people, they'd come in, they say, hey, I want to sit down and talk to you. I'd go through their portfolio, and they were 99% real estate, or 90% real estate, or 80% real estate. And I was like, you're not diversified enough. They're like, oh, but I'm doing good. I have 13 homes. This is the best thing ever. Like, yeah, except for when they go down, and your 4 million net worth just went down to 2. I have a client that happened to. He's in his 80s. Real estate's always done well for him. He's getting ready to sell his homes because, he doesn't want to be a landlord anymore. 13 homes, net worth about $4 million. By the end of 2009, they were worth less than 2. And he was underwater on quite a few, right? To this day, he still has about 7 because that's how many he's been able to get rid of. You can get really greedy. You got to diversify. Don't get all into one asset. It's very, very, very important. Second thing, we just talked about the human emotion, right? And this really is all about timing. So let's talk about, see if the Bible says anything about timing. Let's go to Ecclesiastes, a couple pages back, 3:1. Actually, my father used to tell me this as a kid all the time. So 3:1 says, to everything there is a season and a time to every purpose under the heaven. Go to 6. We're going to skip down to 6. A time to get, and a time to lose, and a time to keep, and a time to cast away. How about that? I think we can use that towards investments, right? And what I mean by that. So one of the things that I talk about to almost all my clients and anybody that's willing to listen is that don't tell me what to buy. That's good. Buy Apple, right? It's good. Tell me when to buy it. That's why the cycle of human emotion is so important. Because if I buy Apple at euphoric times, my odds of winning are okay if I keep it a long time, right? But my odds of losing short term are probably pretty heavy, right? As opposed to buying it when nobody wants it, my odds of growing and making money are much better. So don't tell me what to buy, tell me when to buy it. And every investment has a time to buy and a time to sell. Go ahead, Venkat. That's right. So Venkat said the famous quote from Warren Buffett, be fearful when others are greedy and greedy when others are fearful, right? Yeah, that's called value investing in our world, which hasn't worked, by the way, for the last decade. So like I said, everything has its time, right? But there was a quote, I was actually on Twitter earlier today, and he had a quote on there. He believes this is a perfect time to short the market, but he said, I'm not shorting because people are crazy enough to keep pushing this market higher, right? So he understands already it's overvalued because look at where we're at today, right? I mean, that's pretty scary. If you look at the cycle, right? Something's not right. Real easy to see, right? So diversify, know when to buy and when to sell. And next thing when you're investing is all about cost too. So we talked about the idea that the market, if you go back to the 1920s, has returned about a little over 10% on average for that whole time period. So if you started investing in 1920, you kept it in there through all these years, your average would be about 10.8, 10.6 right in there, sometimes 11, depends on who you ask. But so there's mutual funds, and we'll talk about mutual funds versus ETFs. So mutual funds started in 1932 was the first one. That's where you could pool your money with other investors, and that way you could buy many stocks as opposed to one for a fee. Well, the stock mutual funds over that period of time have returned right about what the market's returned, almost to a T. But the average investor that's owned mutual fund has only returned about 1.8. So how could that be? If you own the same investment over the same period of time and your return is almost 90% lower. That's right, the cost, right? Management fees is one, all the trading costs, but the other is that during that time frame, most investors don't stay in. Because if I put my money in 1999 and a year later it's worth 50% less, what are you gonna do? I'm out, right? You can stay in, it's okay, you can stay in. I don't care how many times you tell somebody to stay in when they've lost 50%, they're running. They just are. It's just human nature, right? Now some stay. Usually it's people who are still working and say, well, I'm still at it, I got time, and they'll stick in there. But as a whole, the only reason it goes down 58% is because people are running, right? They're like, I gotta get out before this thing falls apart, goes to zero. By the way, has the market ever been zero? I think in 1930, don't quote me on this, 1929, I think it went down to 54 points on the Dow, if I remember correctly. Down 254 points. The number was 54. Yeah. There's a great story about that, by the way, too. There was an investor by the name of Jesse Livermore, who at the time actually had shorted the market. So this is how emotion works sometimes. So he was a great investor, and sad story, he killed himself in the end, but because he wasn't Christian. But the day that the market collapsed in the 20s, he was actually short the market. That means he was betting against the euphoria, right? It was euphoric at the time. So he went home after the day. He had made, get this, over $1 million that day. That's like making $1 billion today, back then. He went home, all the lights were off in his house, on his little house on Long Island with his 300-foot boat behind the house. And as he walked in, he's like, where's my wife? All lights are off, where's she at? Nowhere to be found. And he noticed all his artwork and everything, furniture was moved around. There's like he'd been robbed, right? He's like, well, that's kind of sneaky. But then he saw the lights out in the guest house. Like, well, I better walk out there and see what's going on. His wife was in the guest house surrounded by old furniture, jewelry, and artwork. And he goes, what's going on? He goes, well, I heard the market collapsed today, so I figured we broke. She didn't even know that he had shorted the market, the opposite. Because he was a great investor, he was actually doing the opposite of what all their friends and family were doing, right? He was buying and selling at the right time. So the sad story about that is, like I said, in the 60s, he ended up shooting himself because his whole life revolved around the greatness of his investing. And even the greatest investors lose money sooner or later. He lost money sooner or later, right? We'll talk about why that's important later. Diversify, know when to buy, know when to get out, control your costs. So let's talk about how do I invest. I've shown you the S&P 500. So how many people know what a mutual fund is? Right, very common. Basically, it's a pool of stocks or bonds that a manager, usually in New York, manages for you, along with millions of other people together. Actually, a pretty good product, started, like I said, in 1932. It was a way for the common man to be able to get diversification into the market. You didn't have to buy one stock. You could buy one mutual fund, and it had a lot of different stocks in there. Very easy. There's, I think, 4 trillion in mutual funds right now, if I remember correctly. So they're a big, big deal. But in the late 70s, I think John Bogle from Vanguard invented the ETF, which we'll talk about a little bit differently. So on average, if you look up here, we're going to compare ETFs versus mutual funds. The thing with mutual funds is there's all kinds of different shares. There's A shares, B shares, C shares, D shares, E shares, I shares. There's just R shares now. All that means is how they bill you, right? So if you have an A share, for example, they charge you, if you put in $10,000, they'll charge you 5.5% to buy it, plus a management fee yearly, about 6% your first year. Sound like a good deal? You start off quite a bit down, right? Not a good deal. So the mutual fund companies, Wall Street, we'll talk about Wall Street, said, that seems a little harsh, so I know what we'll do. It will say we don't charge you anything, but we'll charge you 5% up front, and you'll get to write that off over the next, not write off, but basically we'll do that over a 5-year period. So when you get to the 5th year, then really the fee goes away. Not the management fee, but just the upfront fee. So the advisor gets 5% anyways. You pay it as an investor, but you don't see it as long as you stay there 5 years, right? Have another way of taking your 5%. The last one is C shares. So C shares are an answer to RIA platforms where we charge a management fee to manage your whole portfolio, and it's usually about 1%. So they say, look, why don't we do this? If you invest in C shares, we'll only charge you 1%, and if you stay a year, we'll remove that, and you won't have to pay it anymore, right? But we'll put it in the management fee, right? That's actually one of the most expensive ways to buy it because they double the management fee. So you don't see it at first. In fact, you don't ever see it because it's all inside the prospectus that most people don't read, right? So it's a very expensive way to do it. So on average, if you add those, put those together, C shares, B shares, A shares, you put together all the other shares combined, on average as a whole, it's about 1.844% management fee per year for most funds. Some higher, some lower, right in there. So what happened is Bogle from Vanguard decided that there had to be a cheaper way to do it. So he created what's called an index fund. You guys remember the S&P 500, right? That's an index. That's the top 500 companies in America, right? From Apple on down. So when he created his index, let's compare the costs. There it is. Now that's Spiders, which is relatively close to what he did. It's actually, so 0.9% as opposed to 1.84%, right? And it gets even better. So when a mutual fund manager in New York or wherever he is in the world is managing money, who does he measure his performance against? The S&P 500, right? So if I beat the S&P 500, I'm a great manager. If I don't, right? And the stats show that over 90% of the managers don't beat the S&P 500. So here's my key. If 90% of the managers on Wall Street don't beat the S&P 500, and the S&P 500 is what they measure their standards by, Why don't I just buy the standard? Simple, right? Not rocket science. No manager attached. I buy my 500 companies. I pay almost nothing. And now there's not even any trading costs because of Robinhood, that basically all the brokers got rid of the trading costs. Now I have to get paid, right? So my fee goes on top of that, and it's still lower than the 1.84. That's how we do the business, right? But, so one of the questions you guys, I've been asked actually here at church, and really relatively all the time, is what do I buy, right? What should I buy? Sorry, sorry. Wow, that was a cough. That's a big cough. Yeah. So the S&P 500 is where I would start, because that's the standard that Wall Street uses, right? It's also the most highly traded security on the market every day. It's liquid like water. It trades so many shares a day that the spread between the buy and sell is so small, so minute, that if it's trading at, say, $100.50, you'll get it for $100.50.008, because it just trades that liquid. So that's one. Why do I like ETFs better than mutual funds? Second reason is tax efficiency. If you buy an ETF today and you keep it for the next 10 years, how much do you pay in taxes? Zero, because you haven't sold it. As long as you don't sell it, no taxes. Pretty efficient, right? Now, there is some dividends that you get, so you pay taxes on dividends, but that's the minor part of it. As a mutual fund, on the other hand, if you own a mutual fund in a taxable account and you hold it for 10 years, do you have taxes? That's right, you do. Every year they have to issue capital gains. Even though you didn't sell your mutual fund, they do all the trades within the pool, and then whatever that gets divided up to your portion, they send it to you at the end of the year. Now, I never understood why some clients love that. They're like, what's my capital gains this year? You don't actually get that, you just pay the taxes. But they thought it was a great thing, you know? I never quite understood that. Like, that's not a good thing. I understand you think that you made money, but that's not what it is. The capital gains is just a tax bill, whether you made money or not, by the way. Now, where they really got a little crazy is that the mutual fund could actually lose money for the year and you still have a capital gains tax. How sweet is that? Not very, right? That's right. Even Sam goes, I know that's not good. There's no penalty on what we're talking about because it's within the account. Now, if it's within the retirement account and you take the money out, then there would be some penalties there. But for these purposes, we're just talking about a regular account. So S&P 500, one of the core holdings that I think should have, because basically it's an easy way to buy the American economy, right? You're buying the top 500 companies in America. Now, since 1970 and something, when Vogel started that first fund, which was basically the index fund that he started as a mutual fund, by the way. It wasn't an ETF, it was a mutual fund, but very low cost, no management. Everybody kind of laughed at it on Wall Street. They're like, why would we ever buy a fund that has no manager? That's ridiculous. Well, Vanguard is the largest mutual fund company in the world now. I think his idea worked, right? So they have ETFs now. That's even better. So no, the tax efficiency is better. The other thing is a mutual fund. When you buy a mutual fund and you say, hey, I think the market's going to crash tomorrow. I got this feeling. I got to get out. Call your advisor. He says, okay, you'll get out at the end of the day. Well, wait a minute. I think the market's going to crash tomorrow. Well, too bad. You can't mutual fund until the end of the day. That's just the way it works. Whereas an ETF, you call me, you say, hey, Jose, I think the market's going to crash tomorrow. I need to get out. Okay, at opening bell, I'll put in the order, you'll be out, right? So they trade like a stock during the hours of the market, and now even after hours to some extent. Whereas a mutual fund only trades once a day and only at the close of the day. So a lot can happen in that one day, right? So that's the other reason that we use ETFs. Let's see, let me go back to the ETF. Oops. All right. Trade during hours, capital gains, trade at the end of the day. The other thing is that nowadays with ETFs growing huge, in fact, it's now $2 or $3 trillion of money in ETFs. You can get every kind of ETF that you want, right? Not just the S&P 500. So our portfolios usually look like this. We have VTI, which is the Wilshire 5000. It's a Vanguard product. And basically with VTI, one purchase of this particular ETF, you basically own the entire market. So you just click, buy, boom, it's yours. It's all yours. You own every stock. You want diversification? That's diversification. Right? Can't get any more diversification unless you add international. QQQ, that's the NASDAQ 100. That's for everybody that wants that. Got to buy some aggressive stocks. Got to buy something that's growing fast. You've heard the FANG terminology. That's your basically Microsoft, Apple, Google's in there. Tesla's in there now. So I think Microsoft, Apple, who am I forgetting? Amazon is like 35% of that index. It's a huge portion because it's all cap weighted, right? It's all the size based on the size of the company. That's how much more you own of that company. Does that make sense to everybody? So the bigger the company, the bigger portion of the index. Now they have other indexes now that are fancy and all that, but the numbers haven't shown that they do any better than the cap weighted indexes, right? We have V&Q. So this is the one that I did a few years ago after the crash of 08. I had a client who bought a house and because he wanted to get money and he says, I need to buy a house so I can invest in it. And I had this great deal in Anaheim, California where the market's really hot. I said, okay, I'll tell you what, you buy your house, I'll use the other portion of your money and I'll buy V&Q, which is a real estate investment trust index, which inside of it has, so basically you can buy real estate right through the market. Here's the key about that fund. 95% of all earnings that they make have to, by law, go out to the investor. They can only keep the 5% to manage the product. The rest of it has to go out to you one way or another. I think that's pretty good, right? Inside of it, they own things like malls, hospitals, buildings, commercial buildings, pretty much anything you want, apartment complexes, that's all in there. So it's a pretty safe way to buy real estate. Plus, it's liquid. You don't have to close, right? You can just push the button. So anyways, story goes, he bought a house in Anaheim, California for about $350,000. For those of you who don't know, $350,000 in Anaheim, California is really, really cheap. Okay? He says, I'm going to fix it, put about 30 grand into it. I'm going to flip it. I'm going to make all kinds of money. All right, let's do that. 6 months went by. He got it all ready. What I tell you about when it was? During the real estate debacle, right? So how good a price do you think you got? How about no price? He couldn't sell it, right? Nobody's buying during that time. My investment was up 69% at the time. Same real estate market, I don't get it, right? But the real estate at the time was everybody was moving away from individual houses and into hospitals and bigger things, and that was inside of there, so that was doing really well. So he was not happy. Not with me, but he wasn't happy with the situation. He did finally sell the house. I think it was about 8 months, 10 months later. But by then he had already lost money, right? Because he was running a tight schedule. He had to make a certain amount. And mind you, there's a mortgage involved when he's stretching that out, right? So that's why I'm not a huge fan of rentals, but some people are. It's okay. So we have that one. We have gold, the GLD. You can actually buy GLD on the market. GLD is directly related to gold bars. So it trades up and down based on what the gold does for the day. So you can actually buy that and you own gold. You don't have it physically in your pocket, but it's directly related to gold. So it's a way to get gold without having to go buy heavy bars. XLE's energy, that's oil. Well, here in Houston, you would know everything to do with oil is basically here. So that's what XLE is. XLE is just directly buying the oil companies and the oil producers, the oil pipelines, and all the services that help oil continue, right? So that's what that energy is. The next one is VT, that's the total world. So that's basically every stock in the world except the ones in the United States. So people say, well, why would I want that? Well, what did I say about PlayStation recently, right? Is that a US company? No, it's actually a Japanese company, right? So if you want to be partaker in the PlayStation blow up right now, you would have to buy Sony, which is actually a Japanese stock, right? GLD. You're going to go buy that? So Sam said, for those on Zoom, he's going to buy GLD and then show that to Marla and say, hey, I bought you gold, right? Don't need jewelry. I buy you gold, but here you go. Yeah, that's, honey, I'm buying you GLD. There you go. Okay. The next one we have up there is we have BWO, which is the emerging markets. That's, your Asian, Indian, kind of your growing country, necessarily, not third world, but pretty close, right? Emerging markets means emerging economies. Then we have bonds. This is fairly recent. I mean, up until I think probably 15 years ago, you couldn't even get a bond ETF. Now you can. So you can buy US Treasuries right through an ETF. Because there's a couple ways you can buy US Treasuries. You can go to whatever broker's desk. They call it the bond desk. You can pay you can buy them through there. They'll usually charge you a small commission. Or you can go directly to the US Treasury. I don't know if have you guys ever done that? That's actually kind of a great experience. First of all, their systems are terrible. But second of all, you actually can go buy US Treasury bonds right online. So, and some of them are pretty good, some, But you can also buy as an ETF. And then the last one I have is 1 and 3 year Treasuries. So that's Treasuries again, a little bit longer term, 1 to 3 years. You can get them as long as 30 years right now. So something the US government should do, and you can put this down. They should issue 50 or 100-year bonds right now. Why do you think they should do that? Why do I say that? Any guess? What's the rates right now? Very low. Because how they finance our debt is through treasuries. So if you're going to finance it, why not finance it for 50 years at 2 or 3%? Whereas 5, 6, 7, 10 years from now, that might be 5, 6, 7, 8, 10%, right? That's a huge difference on trillions of dollars. And they're issuing, the most they'll issue is a 30-year bond. I believe, who was it? I want to say it was Germany, but one of them issued a 100-year bond. And if you really, really love Apple, Trina, they actually have a 100-year bond that Apple put out. I think it was paying less than 2%, and people actually bought it. Sold out day one. Yeah. There is actually a thing called an I bond. That's a U.S. Treasury bond, but that's not what it was called. But yeah, they should have called it that. They couldn't. The name was taken already. So you can. So if you look at this portfolio now, I haven't actually put in the percentages of how we buy it or what we buy. But what I'm trying to tell you, you don't really need me if you're willing to put this together, take some time, study it, and then hold on to it for a long period of time. So when the heart attack comes, you better just hold on tight, right? But the reason people do hire somebody like ourselves is because we want to, A, avoid those heart attack times as much as possible. And then when they do come, we have to have a game plan of how to attack that, right? That's really why the advisor world exists, right? In fact, the Bible says seek good counsel, right? So I do think that what we do is rather, well, I just think that the pastor talked about doing stuff for the Lord, and that's the way I see it, right? He talked about that this morning. I thought his sermon was really good. Did you guys catch the tea in boiling water makes tea? Did you guys get that? Thought that was pretty good. Anyways, I've covered a lot in a real fast time because it's our last day. So go ahead, Sam. Yes, I did. What was the first rule? Okay, let me go through it. So Sam asked, you teach all the time. I tell you guys to buy this, buy that, but you don't teach us how we save, right? How do we get there? Where do we get that money? Yeah. Well, so if you followed what my classes were, I guess I'm not teaching well enough, but
I listened to you. I saved some money, but in the future, we go out.
Yeah.
And I put 10 times that money on it.
Right.
This one, you know.
Yeah. Then, you know. So that's actually a good question, though, in the sense that we talked about that first fruits tithe, Make sure you take care of your family, put away some savings, make sure you have an emergency fund, and then we get to investing, right? Then we get to this. It's the steps. The key is, I think if you're reason I call it the faithful steward, if you're being faithful and following what we've taught you today over the last 7 weeks, remember, because although I teach this at work because of, that's what I do, I don't teach it at work from the biblical standpoint, right? But it's very biblical, everything that we've learned, right? First fruits, so your money will be blessed. Save for your family, take care of your family. It talks about that very clearly in the word, right? And so throughout the entire Bible, the word of God talks about how we must be faithful with our resources, right? And if you are, you'll be blessed. Some more than others. One of the things that's really hard for me, that was really hard for me in this industry, is that I deal with a lot of wealthy clients, right? And we know in the word of God, there's a lot of wealthy people that were really bad people, right? Didn't get saved, won't end up in heaven. But there's also a lot of wealthy people that are part of our Bible from day one, right? Abraham was very wealthy, right? David wasn't broke. He was a king, right? Solomon. You go on and on and on. There's a lot of men of wealth, a lot of great men in the Bible that had wealth, right? They faltered some, most of them, all of them, right? So wealth itself, we learned that back in week 3, I think. Wealth itself is not bad. It's what your heart is doing with the wealth that's bad, right? Okay. We got about 10 minutes. I can go into more stuff, or I can kind of wrap it up. Really up to you guys here. See if I miss. So one of the things that I wanted to cover is this, our investment philosophy. So we talked about it, right? Diversify, right? Very important. Never put all your eggs in one basket. We've heard that a million times. One of the things I always hear sometimes, well, Jose, but if I give you my money and you put it all in stocks, isn't that all in one place because it's just you? I get that sometimes. The answer is no, because we're actually buying the S&P 500 and all the other things. That's where the money's at, right? It's not just with me. It's actually in those investments. So that's diversification. Buy low, sell high. We talked about the emotional cycle, right? So you want to buy when things are bad, sell when things are good. Identify and reduce risk. That's really what I do 24/7, is always looking for risk, right? Where's the risk coming from? And I think if you're praying and watching your resources diligently, the Lord will make you aware of those risks, right? And they can come from anywhere. I believe that in 2007, when people were buying houses and markets were going crazy, they didn't see the risk, right? Because everybody around them was like, hey, everything's good, right? My house just went up 20% last week, right? So risk can be anywhere and everywhere. Control costs, that's very, very important. We talked about the returns of mutual fund investors and why controlling costs is very, very important. That's why we use ETFs. Then personalize your client, personalize your portfolio. Here's the thing. What might be a good investment for Trina might not be a good investment for Gary, right? For whatever reason. It's all about making the portfolio work for you, the investments work based on you and your risk tolerance. Okay. Now, in our firm, we use the investments the same for everybody because we believe we're buying good investments. So if they're good for one guy, they got to be good for the other. What we change, that Sam asked, is the percentage that we own, right? That's what we change. We don't change the investments, we change the percentage that we own, because some investments are riskier than others. Generally speaking, stocks are riskier than bonds, generally speaking. So if I'm investing for somebody who's 90, they might only have 20% in the stock market, as opposed to somebody who's 30, they might have 80 or 90% in the stock market, right? They have more time. It can fluctuate for them a little more than the 90-year-old. Although I have 90-year-olds that are very aggressive. True story. They're like, I ain't got long to live, just invest it all. Doesn't matter. I do. I have a view like that. I have others that are very scared and they don't want to do that. But so the other question I get Jose, I know you invest in stocks. You taught me a lot about stocks. You taught me about bonds. But really, I just want something that's guaranteed. Anybody ever heard that? Yeah? I'm sure you've heard it. So here it is. I'll give you my one guaranteed investment. You ready? The Lord Jesus Christ. That's it. That's it. There is no other. GLD. No. No. But we started this whole faithful stewardship with what? Our heart. It's all about the Lord wanting our heart. That's what it comes down to. Investments will come and go. Money will come and go. But salvation is forever. And if you haven't given your life to the Lord, I can't guarantee you anything. That's the way I see it. So I've had fun. I've enjoyed it very much. And somebody always said that if you don't have any questions, that you did a good job. So hopefully. Oh no, Sam has a question, so I didn't do a good job. But yeah, honestly, that's the way I see it. Is that this company that I run, I do it for the Lord, and what the pastor said today is absolutely how I try to live my life. I try to live that what I do is for Him. It's not for anybody else. And so, I can tell you that through this last 7 weeks, I don't know how you guys felt about it, but I have been just so moved by so much more than I learned that can go on and expand into what the Lord was saying to me through this study. And I hope that someday we can really dig even deeper. 7 weeks was just scratching the surface, honestly. And I'm so excited. Even today, when I was trying to wrap it all up, I was like, yeah, but I got to talk about this. Oh, I got to talk about that. Oh, no, I see this now. And I mean, I didn't even know Ecclesiastics existed. And yet today I was in Ecclesiastics the whole day. I was like, where'd this come from? I didn't know there was money talking there. Anyways, hopefully you enjoyed it. And, like I said, to me, the only guaranteed investment is the salvation the Lord provides to us through Jesus Christ and Jesus Christ alone. No. Thank you guys for listening, sitting here for 7 weeks and listening to me. What I'd like to do is I'm going to go ahead and close, unless anybody on Zoom have any questions? Can't see them right now.
No,
hopefully
not me.
Okay, thank you. I knew I could see them somewhere. Venkat, will you close this?
Father, we thank you and praise you for your blessings. We thank you, Father, for the salvation that we have. You sent us here and that we have from it. Help us now, Father, to be good stewards of what you have given us and the things that you have entrusted us with. We ask, Father, that we can learn and know how to manage. To be good with our lives, our actions, and our words. We ask these things in Jesus' name.
Amen. Thank you, Venkat. So, like I said, if you have questions, I'll be staying. I don't have to rush off today like I did last week. So we could definitely, I can answer any question you might have. Gigi,
Yes, sir.
signing off. Is that okay?
Yes, sir.
Okay.
Good night, and thank you so